If you've been watching gold and silver over the last 2 days and thinking this feels unreal, you're not wrong. But what makes this moment dangerous is not the speed of the move. It's the fact that most people are still interpreting it through the wrong lens. Gold above $5,000 is not a rally. Silver above $100 is not excitement. These prices are symptoms, and the disease is confidence decay. Markets don't break when panic is loud. They break when trust quietly leaks out and nobody notices until price forces the conversation. That is exactly where we are right now. Gold didn't wake up one morning and decide to set a record. It moved because capital is repositioning ahead of instability that hasn't fully surfaced yet. And silver isn't following gold the way people assume. Silver is reacting to pressure from both sides at once, financial and physical. And that combination is historically explosive. This isn't a trade driven by headlines. Headlines arrived late. The real trigger sits beneath the surface, in the plumbing of the system, where monetary authority, political influence, and industrial dependency are colliding. Start with gold. Gold crossing 5,000 tells you something simple, but uncomfortable. The market no longer believes monetary credibility can be preserved without cost. That belief doesn't require a crisis announcement. It forms gradually, then expresses itself suddenly. Gold expresses doubt. Silver expresses consequence. Silver's move matters more than gold's right now, because silver is not optional. It is not decorative. It is not symbolic. It is embedded in supply chains that governments rely on and industries cannot pause. And that creates a different kind of stress. When silver jumps 8% in a single day and climbs more than 50% in weeks, it is not speculation running wild. It is a repricing event triggered by scarcity meeting urgency. People underestimate how fragile silver supply actually is. Most silver is not mined because someone wants silver. It is mined because someone wants copper, zinc, or lead. Silver shows up as a byproduct. That means supply does not respond quickly to price. You cannot fix a silver shortage by raising silver prices alone. At the same time, demand is not discretionary anymore. Electrification, medical equipment, water purification, data infrastructure, and renewable energy all require silver. These sectors do not slow down because price rises. They pay up or they stop operating. That is the asymmetry people are missing. Gold can be hoarded. Silver must be consumed. That distinction changes how markets behave under stress. Now add the macro layer. Political pressure on monetary institutions is no longer subtle. When central banks appear constrained, markets assume accommodation will come eventually, even if it is delayed. That assumption weakens currencies over time. Not instantly, but persistently. Currency weakness does not need hyperinflation to matter. It only needs uncertainty. When uncertainty rises, capital seeks neutrality. Gold and silver offer neutrality. They do not vote. They do not negotiate. They do not issue guidance. That neutrality becomes valuable when governance feels unpredictable. This is why focusing on short-term explanations misses the point. Yes, tariffs matter. Yes, geopolitics matter. Yes, rhetoric matters. But those are sparks, not fuel. The fuel is structural imbalance. Debt levels are high. Policy flexibility is limited. Political incentives discourage restraint. Central banks face pressure from multiple directions. None of that creates confidence. So capital moves quietly at first. Then visibly, silver is now visible. And visibility changes psychology. The danger for new participants is assuming this move must end because it feels fast. Speed alone does not define exhaustion. Participation does. Right now, participation is still selective. Most institutional money has not fully engaged. Pension funds are not allocating meaningfully yet. Sovereign wealth funds are not chasing silver exposure aggressively. Large asset managers are still debating whether the move is sustainable. That debate itself is evidence of early stages. Markets top when debate disappears. We are not there. But that does not mean the path is smooth. Silver never offers smooth paths. It punishes complacency and rewards patience unevenly. Volatility is guaranteed. Pullbacks are inevitable. Emotional tests are part of the process. The people who struggle most are those who treat silver like a stock. It does not behave like one. It behaves like a stress indicator that overshoots, corrects violently, and resumes direction before consensus catches up. Understanding that behavior matters more than predicting the next dollar move. If you own silver without understanding its personality, you will be shaken out. If you understand why it moves the way it does, volatility becomes manageable. Gold's role here is confirmation. Silver's role is acceleration. Gold tells you trust is eroding. Silver tells you the consequences of that erosion are becoming unavoidable. That is why these moves feel different from past cycles. This is not just monetary fear. It is monetary fear colliding with physical necessity. That collision does not resolve quickly. And this is where perspective matters most. People keep asking whether gold at 5,000 or silver above 100 is expensive. That question only makes sense if currencies remain stable reference points. But if currencies are what's being questioned, then price alone is misleading. What matters is purchasing power, not nominal value. And purchasing power is exactly what gold and silver are defending right now. What makes this moment especially deceptive is that nothing looks broken yet. The lights are still on, markets are still trading, people are still arguing about whether this is sustainable. That's exactly how these transitions always look before they become obvious. Financial systems rarely fail loudly at first. They strain quietly, they distort incentives, they reward behaviors that shouldn't be rewarded, and punish caution until the imbalance becomes too large to hide. Gold and silver are responding to that strain, not predicting apocalypse, but reflecting pressure. When gold crosses 5,000, it's not saying collapse is imminent. It's saying stability is no longer assumed. That's a subtle but profound shift. Stability used to be the baseline. Risk was the exception. Now uncertainty is the baseline and stability must be earned. Silver's behavior confirms that shift because silver sits at the intersection of finance and reality. It cannot be abstracted indefinitely. You either have it or you don't. You either source it or production stops. This is why silver tends to move later than gold, but faster once it starts. It waits for stress to become unavoidable. Then it reprices in a way that feels chaotic to anyone expecting orderly markets. That chaos is not random, it's structural. One of the most misunderstood aspects of silver is how thin the market actually is. It does not take massive new demand to overwhelm supply. A modest reallocation by institutional players or industrial users can push prices dramatically because inventories are not deep. Most people assume there's a large buffer somewhere that absorbs spikes. There isn't. Silver inventories are distributed across industrial supply chains, private holdings, and financial vaults that rely on confidence to function. Once confidence wavers, the buffer disappears quickly. That's when price gaps happen. And gaps don't resolve gently. This is also why comparisons to previous cycles can mislead. The world today is not the world of the last silver spike. Industrial usage has expanded, financial leverage has increased, policy constraints are tighter, debt burdens are heavier, the system has less room to absorb shocks. So when silver moves now, it does so in a more brittle environment. Brittle systems don't bend, they snap. That doesn't mean silver goes straight up forever. It means corrections are sharper and recoveries faster. It means price action feels unfair, irrational, and emotionally exhausting. That's not a sign of failure, it's a sign of stress redistribution. Another mistake people make is assuming silver needs public enthusiasm to keep rising. It doesn't. It needs necessity. Public enthusiasm amplifies moves late. Necessity drives them early. Right now, necessity is doing the heavy lifting. Energy infrastructure doesn't pause because silver is volatile. Medical equipment doesn't substitute away easily. Defense systems don't wait for price stability. They pay up or they secure supply early. That behavior creates a floor under demand that didn't exist in purely speculative cycles. This is why dismissing silver as overextended based solely on price ignores the structural backdrop. Overextension only matters if demand is elastic. Silver demand is becoming inelastic in key sectors. That's a game changer. It also changes how pullbacks should be interpreted. In elastic markets, pullbacks signal waning interest. In inelastic markets, pullbacks signal temporary liquidity adjustments, not demand collapse. Understanding that distinction helps avoid costly mistakes. Now consider the broader capital flows. Institutional investors don't rush in. They watch. They wait for confirmation. They debate internally. But once thresholds are crossed, once performance becomes impossible to ignore, they move decisively. Gold at 5,000 forces those conversations. Silver at triple digits accelerates them. And institutions don't nibble. They allocate. That allocation doesn't require euphoria. It requires justification. And justification is forming now through performance, macro conditions, and peer behavior. This is why dismissing the move as too far, too fast misses the second order effects. Price changes behavior. As prices rise, previously unviable projects become viable. As prices rise, risk managers reassess exposure. As prices rise, portfolio construction changes. Those changes feed back into demand. This is how trends sustain beyond initial catalysts. But sustainability doesn't mean smoothness. Silver will remain uncomfortable. It always does. It is not a metal designed to reassure. It is designed to expose fragility. And fragility is what markets are slowly acknowledging. If you're holding through this, the temptation will be to constantly reassess based on short-term moves. That's exhausting and often counterproductive. A better approach is reassessing based on whether the underlying reasons for ownership have changed. So far, they haven't. If anything, they've intensified. Debt remains unresolved. Political influence over policy remains elevated. Industrial demand remains firm. Supply remains constrained. Institutional participation remains early. None of those conditions suggest completion. They suggest continuation with volatility. And volatility is not an argument against ownership. It's an argument for preparation. Preparation means position sizing that allows you to hold through drawdowns. It means avoiding leverage that forces liquidation at the worst moments. It means clarity about time horizon. Silver rewards those who respect its nature. Disrespect it, and it will punish you. Respect it, and it becomes manageable. This moment is not about predicting the next headline or the next dollar move. It's about recognizing that something fundamental is being repriced and deciding whether you want exposure to that repricing. Waiting for certainty usually results in higher prices and lower confidence. Acting without understanding results in regret. The balance lies in clarity, not courage. At some point, every market transition reaches a phase where the debate shifts. Early on, people argue whether something is happening at all. Later, they argue about how far it can go. That shift is subtle, but it matters. Gold and silver are now past the first argument. Nobody serious is asking whether something is happening anymore. The only real disagreement now is scale, timing, and durability. And that tells you more than any indicator ever could. Markets do not reprice fundamentals quietly. They reprice them through discomfort, through disbelief, through volatility that feels designed to shake conviction rather than reward it. Silver is doing exactly that. And this is why people who are new to the space often misinterpret what they're seeing. They expect logic to look calm. They expect confirmation to arrive gently. But confirmation in markets rarely feels reassuring in real time. It feels destabilizing. If silver was moving slowly and politely, nobody would be paying attention. The fact that it feels extreme is precisely why it matters. Now, let's address the question everyone eventually asks: what happens next? The honest answer is not a straight line. Silver does not move in straight lines. It never has. It surges, stalls, corrects sharply, then resumes when attention fades. That pattern frustrates traders and rewards conviction. What determines the next phase is not sentiment on social media or technical indicators alone. It's whether the forces driving demand remain intact. So far they do. Industrial demand has not retreated. Monetary pressure has not eased. Policy uncertainty has not resolved. Currency credibility has not been restored. Those are not short-term conditions. They are structural, which means even if prices pause or retrace, the underlying tension remains. This is where perspective matters most. Many people anchor to past prices and assume anything above those anchors is unsustainable. But anchoring is a psychological trap. Markets don't care what feels expensive relative to the past. They care about supply, demand, and trust. Trust is the variable that changed. Once trust begins to erode, it does not recover quickly. It takes years, sometimes decades. During that process, hard assets behave differently than most people expect. They overshoot. They correct violently. They overshoot again. That's not instability. That's recalibration. Silver's role in that recalibration is unique because it bridges two worlds. It protects purchasing power and enables modern infrastructure. That dual role makes it sensitive to both financial stress and real-world demand. Few assets carry that combination. That's why silver tends to lag gold initially, but then outperform once the cycle matures. Gold signals fear. Silver expresses consequence. We're entering the consequence phase. And that phase doesn't end because someone declares a top on television. It ends when pressure is relieved. Pressure is not relieved yet. If anything, pressure is spreading. You can see it in policy constraints. You can see it in debt dynamics. You can see it in the growing discomfort around monetary credibility. You can see it in the increasing need for physical inputs that cannot be digitized or substituted easily. Silver sits in the middle of all of that, which is why trying to trade it purely on momentum is dangerous. Momentum traders eventually get trapped. Long-term holders who understand why they own it tend to fare better. This doesn't mean blind holding without reassessment. It means reassessment based on fundamentals, not emotion. Ask yourself simple questions. Has industrial demand declined meaningfully? No. Has monetary pressure eased? No. Has policy uncertainty resolved? No. Has currency credibility strengthened? No. Until those answers change, the case for silver remains intact, regardless of short-term price behavior. That's the framework professionals use. Retail often uses price alone. Price alone is noisy. Frameworks provide clarity. And clarity is what allows you to act rationally when volatility spikes. Now let's address the uncomfortable truth. Many people will wait too long, not because they didn't see it, but because they waited for comfort. Comfort rarely arrives before opportunity disappears. By the time silver feels safe, it will feel expensive. By the time consensus forms, upside will be reduced. That's how asymmetric opportunities work. It's overcoming the instinct to wait for a perfect moment that never arrives. Markets do not offer perfect entries during structural shifts. They offer windows. Those windows open briefly and close unevenly. The people who benefit most are rarely the ones who felt the most confident at entry. They're the ones who understood the context well enough to act despite uncertainty. That's the opportunity in front of you now. Not a guarantee, not a promise, an opportunity. And opportunities don't announce themselves politely. They arrive noisy, controversial, and uncomfortable. Which brings us back to where we started. Gold above 5,000 is not the story. Silver above 100 is not the story. The story is what those prices are revealing about trust, supply, and pressure inside the system. Ignore that story, and price movements will feel random and frightening. Understand it, and volatility becomes tolerable. The decision is not whether markets will change. They already are. The decision is whether you adapt early or react late. That's the difference between positioning and chasing. And the gap between those two outcomes is usually wider than people expect. Stay focused, stay disciplined, and above all, don't confuse noise with meaning. This is Financial Crux. I'll see you next time.